Hi, it's Lee and welcome to the Tesla Economist. In this video, I wanted to go over the economics as to why Tesla's profits are going to keep increasing for some time. And I wanted to illustrate this with actual financials. Yes, gross margins are likely to keep increasing, especially with improved manufacturing techniques, lower costs, vertical integration, more higher-priced models, and improved efficiencies. However, I'm talking about operating margins and net profit margins, the ones that really matter. Even legacy and Chinese EVs have positive gross margins, although Rivian is still a long way away. We want to look at this until the costs diminish to a level that we can call peak economies of scale and get a rough idea of where Tesla need to reach in order to get there. So firstly, why are these profits going to increase significantly? Like I said, economies of scale, and I can go through the numbers to explain exactly how that will happen. And I don't think anyone else has worked this out yet, as I haven't heard it mentioned, but it means that profits will actually rise faster than people realize, or at least the market expects, which means when earnings catch up to these levels I'm suggesting, it might be a bit of a shock and Tesla's stock price might jump as a result. We often hear how well Tesla's operating margin is doing, and it sounds good because it is, but it will continue to get better as Tesla's production improves continually. Eventually, as Tesla gets bigger, it will start to get closer and closer to gross margin. For example, take Q1 2022. We had gross margin of 33% and operating margin at 19%. Gross is 74% more than operating margins. It's that discrepancy between the two of them that will diminish as Tesla continues to grow. Of course, Tesla's gross margins should continue to increase as factories produce at a faster rate, and Tesla works more magic with vertical integration and moving parts and getting overall costs down and improving efficiencies. Even if prices do have to one day come down to increase demand, that too will also increase operating margin as well. But let's keep gross margin static here so we can get a thorough understanding of how operating margin will improve over time. Alright, how about we make this simple and try and work out where Tesla need to be in order to hit 33% operating margins. Bearing in mind, Tesla were at 15% operating margin for 3 of the past 4 quarters. In other words, this would mean that Tesla's operating margin would just about double. Yes, double. Twice as much margin. We do have to factor in tax for net profits too, which would mean that it's not quite as proportional when it comes to earnings, but we can't get around that. We need to add some more numbers in then. I think I'm happy to maintain a $55,000 ASP. I think that although 4680 vehicles will ramp fast and demand higher prices, equally we really are seeing some serious expansion with LFP vehicles, so the prices should even themselves out. Semi-trucks and Cybertruck and maybe even Roadsters might push up the ASP a little higher too, but I'm good with $55,000. Same for margins. 4680s will improve margins, as will Cybertrucks and those rear-wheel drive Model Ys. Like I say, I really think they are being built at surprisingly low costs, mainly due to the massive ramp-up they've just had in Shanghai. Then of course, in addition to that, we have FSD. The price is rising and Tesla will likely take more of that income and use less as deferred revenue. So I would like to give us a number of 36% gross margin. I really think Tesla are headed for margins that high. You know, if things do eventually go to plan. So we're trying to work out how many deliveries Tesla need to reach in order for operating margins to start to approach gross margins. And we're talking about just a 3% difference here, i.e. 36% minus 33%, or when OPEX is only about 3% of revenue. With that, then the rest is algebra to give us our answer of how many vehicles need to be produced for us to get there. And just to make things easier, we are going to kind of leave out energy and the rest of the business, as they'll just complicate things, and they are a relatively minor part of the business, at least until they aren't. Imagine when energy starts making similar numbers as auto. I've created a table to illustrate what I mean. Now, please bear in mind, this is for indicative purposes only, and just used to illustrate how the economies of scale will increase with the operating margin over time. We're using a higher gross margin than when Tesla did actually produce 20,000 units a quarter, as we're keeping a fixed gross margin. However, obviously, Tesla's gross margins have been increasing too, and likely will continue to as well. In addition to that, it makes a big difference in cost the more the factories ramp up, and the more they're able to produce from the same line. For example, now Model Y is triple volume production in Shanghai. These additional units are costing a lot less than the previous. Therefore, costs decrease further and margins will increase more. Then on top of that, Tesla's demand keeps increasing as they become more popular and add more and more features and value, and thus the price tends to also increase along with that. Of course, on the other side of things are new factories getting started that do initially have lower margins too whilst they're ramping up. But like I said, we're just trying to focus on the difference in operating margin when Tesla increased production. But just look at how the operating profits tear away from the OPEX consistently as they ramp up. When we plot these numbers into a graph, it gives us a great illustration of what I'm saying. Now, just to remind you again, this is indicative and using the same gross margin throughout, but as you can see, the curve is a logarithmic curve and starts to hit its limit, getting closer to gross margin. You can also see a big jump from the start at only 250,000 deliveries. But we see this level out fairly early on, when we reach around 700,000 to 1 million deliveries a quarter. After that, the additional units are less noticed, as that is when Tesla has reached their peak economies of scale relative to OPEX. However, we actually know what Tesla were doing when they did hit 200,000 deliveries a quarter. Their OPEX was actually only around 15%. So in this next graph, I've manipulated the numbers closer to where I see them being without fixed margins. This is taking into account the actual increase in gross margin too, as that is going to play into this a lot. Just to give you another perspective again of what I mean, and I think this might help the most, as production ramps, then essentially the OPEX per vehicle will dwindle more and more. I've also made a graph to illustrate this. If you didn't quite follow what I was saying before, then hopefully this will make the most sense. As you can see, when Tesla were at around 250,000 vehicles a quarter, the OPEX per vehicle was about $7,000. That's quite a bit. But by the time it reaches 750,000, it's less than half, at around $3,000 per vehicle. And then, when we start to get over $1 million a quarter, then we're at about $2,000. In other words, OPEX per vehicle is under 1/3 what it was. Now, compare this to other EV manufacturers like NIO that are at $25,000 OPEX per vehicle. Ouch. Quite the competitive advantage there for Tesla. So that looks cool, but what does it actually mean? Well, it means by the time Tesla reach a run rate of around 3 million units a year, or about 700,000 a quarter, then their operating margin will have doubled, and actually net profit margin will have increased about 80% too, after we factor in tax. This is just margin. Of course, with more deliveries, we also expect more revenue. In other words, a higher percentage of profit on a higher dollar amount in revenue. So going from around 200,000 a quarter to 750,000, we have 3 times the sales. Of course, prices are also up a lot since then too, but we also have potentially around twice the profit margin. In other words, despite only tripling production, we could expect to get at least 6-fold actual operating profit from where we're at 250,000 deliveries. And I'm expecting us to hit a run rate of 3 million a year by the end of next year, especially if 4680s are ramped. So maybe around 5 times as much net profit from Q1 2022 to about Q4 2023. I honestly don't think the market is factoring in any of this. I don't even think they're expecting this sort of run rate until about 2025, and I think they're expecting Tesla to have to lower their ASPs to achieve that, and thus probably even lower their gross margins too. But that's what I do, try and work out just how delusional the market is and try and keep it real for us. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.